So I don't know if you ever wake up in the morning and have a sort of an unexplained sense of doom or foreboding. Well, this morning I had something like that. So I woke up and there was something in the back of my mind that was saying there's just something not quite right at the moment. So I've been thinking about it all day and doing a bit of research. And in this video, I want to talk about some of the reasons why I feel I had that sense of foreboding this morning, and what we can see in the current data as to what's happening with the economy and how that's going to link to the UK property market, and actually ask the question, are all the stats out there just a load of BS? And are the institutions just lying to us to put us into a false state of security while some other stuff's going on underneath the hood? Now, look, I have to be honest, I am not a conspiracy theorist, right? I don't believe that there is, a sort of secret cabal of Illuminati sitting in a underground bunker somewhere that are pulling the strings of the world. But what I do believe is there are major players, major actors, if you like, in many sort of different environments who have agendas and have the ability to influence markets to suit their own agenda. And I've been investing in various mechanisms for over 15 years now. And the one thing that almost happens like clockwork is whenever mass sentiment goes one way, the logical outcome of the market, when mass sentiment says logic dictates we go one way, the market goes the other way. And at the moment, I'm feeling there's, we're obviously running into Christmas. There seems to be a lot more talk about soft landings, interest rates coming down quickly, property market bottoming out. I spoke to my builder recently. He said he's seeing a lot more people come back into the market looking for work after what's been a difficult sort of Q3. He feels that we're at the sort of the end of it and we're going back into growth. And I even saw somebody who I respect a lot in terms of economic commentator talking about house prices returning to growth next year by the end of 2024. Now, when you start seeing all of this narrative, my mind starts going, does this mean we're actually about to go into a massive financial meltdown? Okay, what's the reality? Because has sentiment turned to such a point, right? And logic dictates that CPI is coming down, inflation's coming down. With it, interest rates should go down quicker. If interest rates come down quicker, people's affordability go up, then we can get back into making the property market go up. That's what logic dictates. And there's been a lot of stuff in the news recently about interest rates and how they're now expected to fall sharper and more quickly in 2024 than was previously expected, especially if you go over to the pond, but even in the UK. And my brain was going, wait, there's something not right with this. And effectively, the brain has this great mechanism of trying to give you a gut feeling. Now, if anybody sort of understands how the brain works, we've kind of got two parts to it. If you imagine this is the middle part of your brain, this is called the limbic system, right? Which is the old part of the brain, which doesn't have the ability to communicate, but gives you gut feelings. It's based on your experience. And then it's covered with this bit, which is your neocortex, which is actually the intelligent bit. It's the human bit that actually communicates stuff. And it's this bit inside the limbic brain that often gives us that gut feeling. And that was sort of ringing today for me, and made me very much go back to the market psychology, or the psychology of a market cycle, where you see people make irrational decisions based on perception, right? And actually, we need to have objective figures. So what I'm going to be doing, and by the way, just to sort of reinforce this, I just want to illustrate how this can happen, right? So let's go into COVID. We went into lockdown and everybody's like, including myself, the property market is going to really struggle here. What happened? Nothing happened. And then it went ballistic, okay? A year and a half ago, interest rates start going up. People say market's going to crash. We're here a year and a half later. We are really, probably less than 5% down, peak to trough. It's definitely not crashed. So all that logic that dictates certain actions have not necessarily come to pass. Now, interest rates are peaked, or maybe they peaked, and people are going, we're going to come down again. So actually, it's the opposite. Sorry, we're going to go up again. So interest rates come down, property market's going to go up. Is the opposite going to happen? I don't know. We talked about this Guru Watch last week in my live stream last week with Jim Rogers, who said the world is coming to the end of our good times. Very recently stated this. And he said, I suspect in the next year or two, this is a recent quote, by the way, I suspect in the next year or two, we will see some kind of major problems, long-term problems in the world financial markets. So what I want to really dive into today is, what are those risks? to the world financial markets? And what is the risk in a medium-term timescale? Not the next month, not the next quarter, maybe not even 2024, but as we go further, let's start joining the dots. Let's look at the breadcrumbs of what could happen. What are the potential scenarios in a 25 to 29 sort of time frame? Because I think actually, especially if you're in property investing, right? Property is not a short-term, it's not a short-term model. We're into property for the long term. So actually, fluctuations over a monthly, quarterly, even a yearly basis, unless you're a developer or a flipper, are fairly irrelevant unless you're a long-term holder. So let's look at what this might mean. So right now we've got a lot of leading indicators. So I'm a little bit hoarse today, a little bit at that time of the year. I need to keep drinking. So we've got some leading indicators that I want to look at, or are these leading indicators of where we are going in the economy, right? And I want to look at the leading indicators versus the forecast. So first of all, right, I grabbed this from the November Bank of England report, or not Bank of England, Monetary Policy report. So talking about the labour market, where the headline is the labour market remains tight, although it has loosened since mid-2022. Okay, I would suggest looking at these graphs that it's more than loosened with their own data. So we can see mid-22 is the peak, which is effectively, this is a vacancy to unemployment ratio, which has now been falling. And the purple, by the way, below is unemployment. So over here we're now in effectively unemployment rising, according to this figure. I would say this is more than softened. Okay, this is actually kind of come all the way back down, and we're almost, bearing in mind this is November's data, we're almost sitting at this sort of inflection point right here. That to me is not a good pulse sort of wave if you look at it. And everything that I'm going to talk about today, don't forget we are in the context of the Bank of England saying we are probably only halfway through the effects of the current interest rates being felt by the economy, by businesses, by households. So we're only halfway through the effects, and this is where we are in the cycle right now. So we need to take that into context as we go forward. Okay, so let's go into their projection with unemployment. So here's the fan chart for the Bank of England unemployment rate. So we can see we have, even on their own projections, if we go through the middle of it, a rising line up, with it going up to 5%. But we're still in a bracket, sort of up to 8% on their own projections. So we're expecting unemployment to come up. The other thing we're expecting, and this is official data, okay, is wage growth to come down. So we've obviously peaked at wage growth. We've been talking about the strong wage growth, and something that's been quite major for the housing market in particular is that strong nominal wage growth has been cushioning the effects of interest rate increases, because obviously as people's wages go up, they can afford to borrow more, especially if they're still on cheap fixed rate debt, which of course more people are coming off. But we are now seeing this wage growth come down fairly significantly over the next couple of years. So the strong wage growth we've seen is going to end. However, that's the forecasts. I saw this report over the weekend, and it actually really stuck out to me. So this is KPMG and REC. I'm not exactly sure what REC are, I'm afraid. UK report on jobs. So this is real time. Now, this is not created by a government agency. And I know ONS is meant to be independent, bank, all that stuff is meant to be independent, but let's face it, they report to the government. KPMG, private. Does this mean it's a more valid data set? I don't know, but let's just take that into consideration. Headline is hiring slows again in November, driving quickest rise in candidate supply for almost 3 years. And the key findings here are permanent staff placements and temporary billings are declining. Supply of candidates expands at the fastest rate since the end of 2020, and starting salary inflation dips to a 32-month low. And if we see this on graphical format, this is what I really want to focus on. Okay, we can see we are now, and we've got two lines. I've got to be honest, this report doesn't actually quantify exactly what the light blue and the sort of teal line are. I have a feeling one's permanent, one's temporary in terms of billings. I'm not sure which is which because the graph doesn't state it. But if we look over here, right, we are now in negative on both, okay? The only other times, we've had a little dip here. We've been negative, big spike down in COVID, clearly. And then the only other time we've been down for a sustained period of time below the 50 mark, which is no change. So above 50 is positive, below 50 is negative, was 2008 financial crisis, And when you look at this, sort of the dark blue line is now fairly significantly below that 50. That for me is fairly significant in terms of this particular index. It's a new index that I've not seen before. By the way, I'll be interested to see if anybody else has seen this report, read this report, or seen this index. But that seems to me that the labour market is more than softening. Don't forget, when we talk about property and we talk about property crisis, there are three main things. One of them is affordability, one of them is negative equity, and the other one, the one that's been holding the whole thing up that we talk about, is unemployment. Now, we're still not seeing massive employment, but we are seeing the whole market soften a lot. And I suspect, because the data that's coming out of the ONS is pretty inaccurate, and there's been a big crisis there about the data that's come out because the response rates in those surveys are so low. They've even said they're now having to use experimental data because the reports they're getting are really meaningless because it's such a small data set. Okay, when we look at other data sets like this, that to me is painting more of a picture of the jobs market softening more than we thought. Okay, so that's the labour market as a leading indicator. I want to talk about inflation as a leading indicator. But before I do, I want to ask for 30 seconds of your time to talk about how you can support this channel. Those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Okay, so the other thing I'd like to ask you as we go through is put your thoughts down. As we're going through all of these items, the whole point of these live streams, the reason I do them live rather than pre-recorded is so we can have a conversation. It's really important for me to the community we build that we're talking about this, getting other points of view, seeing where you think things are going rather than just me sort of projecting, because I'm just a dude on YouTube at the end of the day. And it's important that we have some shared thoughts on this. Anyway, let's move on. So we just talked about labour. Let's talk about inflation. So again, here's the forecast from the monetary policy report, November. We can see inflation coming down. There's no surprise there. We're expecting it to come down. The question is the rate of decline and when do we hit that 2% target? Now, if we look at this fan chart, there's something interesting. So I've always said that I feel Q1 or December, as in now, into January, February, we might see a bit of secondary inflation or a little bit of a rise in inflation when the CPI figures come out. And that's because of the rolling 12 months as the data falls out from the previous 12 months ago and is replaced with what we're seeing now. We could well see that little spike. You'll see here, if I zoom in, there's actually a similar, at the top of the fan chart, similar prediction there, although it's a outlier prediction that we might see a small rise in inflation. You can see here they're expecting more of a leveling off. And the reason they'll be saying that is in their forecasts, the bank will be saying, look, we're not going to have huge month-on-month inflation now. So even though the data set that's falling out in the last 12 months is gone, it's not going to be replaced by a big data set. However, energy price cap has just gone up. So who knows? It might well go up. So we are seeing a decrease on inflation, steady decrease. However, here's my issue with CPI. Oh, sorry, I didn't even put that on. Let me go back to that. Sorry, because I forgot to put you back onto the iPad. That's the chart I was referring to. But here's my issue with CPI is everybody effectively has their own inflation rate because everybody who's got different circumstances is going to be affected in different ways. There's no way of everybody calculating their exact inflation rate, but I think most people would agree that the amount of increase they are seeing in their everyday expenses does not relate to the figures that come out in the CPI print. And when we're relating this to the housing market, it's really important to understand in terms of affordability where people are, so that we see the ability to service debt. Because if loads of other things are going up in cost, food, 20%, electricity, I know it's now fallen off, but last year was way more, when you look at the overall inflation figure, that's not what people's actual disposable incomes are being hit by. And when you look at different subsections, it's probably no surprise that a young family, maybe with parents in their early 30s who have just taken their first mortgage or bought their first house in, let's say, 21, 22, with a 2-year fixed rate mortgage, who are now coming off it, are going to be disproportionately affected versus somebody like a pensioner who has no mortgage, doesn't have to pay any rent, right, and has £200,000-300,000 sitting in a savings account that's now earning 4 to 5% interest rate. So we're looking at completely different subsections of or demographics. Subsections of demographics are going to be affected very differently. And the demographics that's going to be affected most by the housing market, okay, are probably the demographics we've just spoken about. So they're probably the low to middle income earners, right, who have stretched themselves in the first place to get onto the property ladder or got high mortgages, been able to afford it on cheap debt. We're not talking about the super wealthy, right, who the cost of electricity is not going to make a massive difference to their ability to service. So when you look at this, the lower to middle income demographics are disproportionately affected. And when we look at CPI and we strip out some of the other elements, this is the housing components to the CPIH rate with electricity, gas and other fuels stripped out. And as I always talk about, okay, everything here is still going up. So we're still seeing large inflation rate for cost of housing, whether that's mortgage costs, whether that's rental costs, okay, the cost to people who are either renting or are on, in mortgages with large amounts of debt, it's going up substantially, and it's still going up, which is why this whole discussion of inflation just suddenly going away, I don't think is particularly relevant when you look at what's happening on the shop floor. An interesting thing that I saw on the charts or on this monetary committee report, monetary policy, Bank of England monetary policy report, is the expectation for medium-term inflation. Okay, so this again was November, came out in November. This chart, just to have clarity here, this is a measure of medium-term inflation expectations in financial markets, and has been drifting up since the start of the year. Okay, so what effectively this is saying is, on a medium term, people think inflation is going to go up again. So we have spoken about some scenarios where, do we see the economy start to get shaky, inflation come down, and interest rates have to be cut quicker? Or, well, they either are cut quicker because the economy's booming, right, and inflation's come down, or they have to be cut quicker because the economy's in a state and it needs interest rates to be cut to cushion it. But then do we see, it's almost like a bull trap, then do we see, after the subsequent, potentially boom in asset prices, if there's quantitative easing that goes in and money is printed again to save this scenario, do we then see inflation come back really roaring and much more sort of sticky and systemic in the medium term? And that's going to cause serious issues. And this is why I wanted to look at not just the next month or quarter, but what's going to happen over the next 5, 10, 15 years in terms of this macro sort of policy, and how would that potentially affect things? So I've said right from the beginning that if we don't have a decent correction now in the property market, and a longer term pullback, gentle pullback is healthy. If we see it kind of flatline and then something happens and we reverse in policy, right, and we go back to QE and asset prices boom again, but inflation isn't actually systemically eradicated, that's going to have much bigger issues down the future if interest rates have to start going back up again, which, by the way, all the yield curves are saying they expect to happen. Okay, so there's some leading indicators of inflation about what potentially, and by the way, these are all forecasts, these are all hypotheticals. This is not anything I'm saying will happen. What I'm talking about here is what may happen. Okay, what may happen. So let's take leading indicators in GDP, because once again, we're being told that actually the economy is much stronger, much more resilient than people thought. This is GDP now adjusted by the Blue Book. So you can see even here we've got a little bit of an increase. So if you follow that line, yes, we've got GDP increasing. Because if you remember, before Blue Book 2023 was about that. But if we take the same data and have a look at GDP per capita, so this is per head, this is what we actually come out with in the UK, right? And that does not look like such a healthy picture. So the narrative is GDP is strong, economy is, well, not strong, GDP is resilient, economy is resilient. We haven't gone into recession. But when you look at GDP per capita, that shows a distinct lack of productivity increase in this country. We're not going to cover it for now, but there's a huge discussion about how to stimulate productivity back in the UK. How do we actually get back to growth? And there's, interestingly, let me just bring you over here. Something I do is, can you see all of that? Or is that kind of lost at the top? You can pretty much see all of it. I curate sort of stories here so I can see trends of what's being talked about. Something that's being talked about a lot at the moment is productivity in the UK. So if we go down here, we've got an article on Britain's productivity standards. This was a Resolution Foundation report that came out that said there's it's been a disaster basically in terms of productivity. This was something that came out today talking about focus on the gilt markets. So effectively it's talking about pension funds channeling all their money into bonds rather than investing it into private companies. And I know if you watch sort of some of Hunt's discussions on the autumn statement, he's talking about trying to get or stimulate investment in UK by things like pension funds to focus on innovation and growth rather than them just putting money to bail the government out basically in the bond markets, which is pretty much what's happening. But we also start to see some interesting threads. Okay, so here we see, let's look at this. Inflation outlook is gloomier. This was yesterday, an article. We've been talking about this for months, by the way, that inflation suddenly just isn't over. Mainstream media talks about inflation. We've solved it. Only now is mainstream media in the financial publication starting to talk about, hey, wait a minute, actually, maybe it's not over. Is it actually a bit gloomier in the UK than we thought? And does this mean that actually rates won't come down quicker than expected? Another article from yesterday, interest rates won't be cut until 2026, predicts the CBI, because of the sticky inflation and the systemic inflation in the system. So we've got, I know you can't see the top of that. It does say, if I could do that, interest rates won't be cut until 2026. If I, it's fine. Don't worry. I'll work on that screen size. So it's interesting seeing these trends of what's being talked about. And I do feel we're at this inflection point right now, this major inflection point. We've got one camp saying interest rates are going to come down quicker than we expect next year. And we've got another camp saying, wait a minute, inflation is sticky. They're going to stay up for a long time. And the reality is, I think it's probably going to take 3 to 6 months until we know what that forward projection is. And whichever way it goes, we'll probably know, I would say, into Q2 of next year when we look at the next 3 months worth of data, is my gut feeling. But right now, there's a real sort of split down the middle of where people think this is going to go. Okay, so I don't think we need to worry about that too much. I think something that I did want to highlight looking at this was money is being taken out the system. So this is aggregate money, lending, aggregate money, and we are negative. So there's money coming out the system. So again, how do we stimulate growth? How do we get the economy working? People are talking about economy is resilient. Economy is not going to go into recession. Economy is going to grow. But with all this money being taken out the system, nothing being invested in, how does that happen? Okay, so those are the leading indicators we're looking at. So we looked at interest rates, we looked at inflation, we looked at employment or unemployment, we looked at inflation, okay, as leading indicators, all of them kind of, I would say, going in slightly the wrong way. What are the risks that we can face here going forward? So recently was the last Bank of England Financial Stability Report, where they do a detailed breakdown of risks to households. They do a breakdown of risks to banks, and then risks to other financial institutions. So let's have a look at some of the points they brought in their risks to households. Now, this has actually been revised down a little bit from the one 6 months ago that came out in the summer, but effectively we are still saying that mortgage payments are going to increase for a lot of households. So even though that chart of interest rates has shallowed a little bit, according to the market-led expectation, we're still seeing between now and Q4 2026 a large increase in the amount of average payments for mortgages for households. And when you break it down, we get a nice bite-size headline of, I think it's £2,900 a year extra for people coming off their cheap fixed-rate debt in 2024. So affordability is still going to be hit. We're still seeing a forward projection of an increase in the DSR, which is the debt serviceability ratio. Okay, So it's slightly shallower than it was in the summer for the same reasons as the, because interest rate path, market implied path is coming down, but it's still climbing, which is going to make people's affordability tighter. And then the final thing to say, and this is just something to put into the audience, put in for discussion points. One of the reasons people are able to afford what they've been affording, and probably has been propping up the market a little bit over the last 12 months, is this massive switch from 20 to 25 year mortgages to 30 to 35 and 35 year plus mortgages. And when we look at this, we can see, okay, the rise. So we got this sort of green line at the bottom here. If I zoom in, that is 35 year plus mortgages. So people are extending themselves for longer periods to be able to get on the housing ladder and stay on the housing ladder. And my thoughts on this are, this is creating an issue that's going to be in the medium to long term. Because when we look at a macro level, what happens when you extend a mortgage term? We're going to pay huge amounts more interest on it over that time. And I'm talking in terms of percentages. I'll crunch it at some point. Massive increases in interest payments for that mortgage, which means as you're paying all of that extra interest payment over the term of the mortgage, you're not putting your money into other things. You're not putting it into savings. You're not putting it into investments. It's dead money that's coming out of your pocket into somebody else's pocket. And that's going to have, I would suggest, a large knock-on effect as we go forward into various aspects, actually. But I don't know if anybody's crunched the numbers and really addressed what is the long tail impact of this long-term borrowing going on. So effectively what it's saying is that household affordability, right, is going to get tighter. It's going to get tighter over the next couple of years. And one of the three big crash mechanisms is income getting tighter. It talks about risks to the banking system. Now, there's lots of different systemic risks to the banking system. I'm not going to go through all of them because it's a fairly dull read, but if you want to read it, just find the financial stability report and go through it. I want to highlight risks to the banking system caused by the property market. And there's a few excerpts I've got here. So we can see that, let me highlight. We've got very sharp falls in global property prices. Now, a lot of this is commercial, okay? We've got high interest rates, a key factor weighing of prices, reducing affordability for residential home buyers, increase in the cost of servicing related debt. Investors, many of whom are leveraged, may face losses as a result of a decline in the value of their assets. This could result in fire sales, exacerbating any downturn and heightening risks to the core financial system. Price falls can also present risks to lenders by reducing the value of the collateral held against their loans. I think this is a really pertinent point and a really interesting point that we should all be discussing. And basically it's saying, and we've seen it, if you remember the arrears charts I put on for the buy-to-let sector, now that's mainly the residential, what that is, the residential buy-to-let sector, where we've seen something like 150% year-on-year growth in people entering the arrears band of a 2.5% or more. If you look at commercial property, where we've already seen a massive correction in commercial property, if this continues, if interest rates stay persistent, if the commercial property market, falls even more, saying that landlords, residential and commercial, could be fire selling, exacerbating the downturn, and this will create a risk on bank balance sheets. Now, especially thinking agreed with the government, look, we're going to give forbearance on people going into arrears. We're not going to start repossession proceedings for 12 months. If you're a lender and you had effectively property as collateral and you saw the value of that property start to come down, and you've said, oh, look, I'm not going to start repossession proceedings for 12 months, but you're seeing the value of that collateral come down until you're going to be going to negative equity. I wonder how many lenders are going to be, sort of nice and, yeah, let's just kick the can down the road in that situation when they are looking at their balance sheets going, wait a minute, we've got all this now bad debt on. And would that create a acceleration of the downturn? Well, this is saying this is a systemic risk in the banking system at the moment. It shows some graphs of property. This is residential property. So we've got US, UK, and the Euro area. I think what's I find something fascinating looking at this graph, that Euro area is a nice smooth line. US is a nice smooth line. Look at the UK's line of all that jaggedness. I wonder if that just reflects how we run this country and how we run the policies and how we're constantly U-turning and pivoting and putting different policies in to appease voters or stamp duty breaks. And, that causes lots of variations, very rapid sawtooth variations in property prices in the UK. So that's interesting. What's more interesting is this is for commercial. These are real estate prices for commercial. And you can see in the UK how much that has dropped in commercial. Now we have bounced a little bit. So it could be an argument that now's a good time to be going, or a re-entry point into the commercial sector, which I personally believe it is, by the way. But we do have potential systemic risks from these commercial property prices going down. Other risks to banks. This is interesting. So it talked about buy-to-let landlords, those not selling and fast selling and forcing down price of properties, passing on higher cost of rents to renters. And we know that there has been a massive boom or a massive spike in rental values. Again, if we go and have a look quickly at our little curation of articles, another one that's come out here, you can't quite see it. There we go. Tenants in Britain hit by highest increase in rent for a decade last month. So we've been talking about rental prices going up. They're still going up, right, at double-digit rates in some areas of the country. This is big. This is a big cost to renters. And what does this big cost to renters mean? Well, it's going to put a lot of pressure on the actual individuals, the actual renters themselves. Okay, so it says, recent bank staff analysis shows that renters tend to be less financially resilient than other households. Indeed, renter households tend to have lower incomes than homeowners, and they are likely to have lower savings. Higher costs relative to incomes could lead to an increased reliance on consumer credit or difficulties paying off existing consumer debt or other types of debt. This could also increase renters' vulnerability to future adverse shocks. And there's an interesting article about what pressures on renters mean for financial stability, but this is the interesting thing. Higher debt and lower savings would make renters more likely to face hard financial choices in the future, like defaulting or cutting spending, which could trigger or worsen a wider economic downturn. So again, this is not a definite. This is analysis of the systemic issues with the property market, with prices coming down and affecting collateral, on banks' balance sheets, versus certain demographics having to cut their spending by a huge amount, which again is going to accelerate a downturn and accelerate issues in the banking sector. I do want to clarify, I'm not saying that all the banks are about to melt down, right? When you read the last paragraphs here, it says, however, banks are unlikely to be severely affected if renters come under further stress, and they do severe stress test ratios and say the banks pass them. But what happens if we see rapid drops in property prices? What happens if we see massive pullback in the economy? What happens if we see renters on suddenly defaulting on personal credit and other credit? All of these things coming at once? It's an interesting scenario. And I have mentioned already the forbearance, which is UK banks agreeing to not start repossessions for 12 months. But if you're a bank and you've got collateral on your balance sheet, it's going down in value and somebody's not paying the rent, how long are you going to keep that for? So that's risks to the banking system from property. What are the risks to the banking system in debt? And I'm focusing on the banking system because the last major property crash came or was the result of the banking system going into what we know as the credit crunch in 2008. So right, that was systemic issues across the banking system that crunched everything and caused the property market to absolutely tank. So what is the risk to the property market? Right now, we're very vulnerable, we're very fragile. Interest rates are high. We are seeing corrections down. It's being cushioned by certain macroeconomic factors. Real house prices have come down very quickly already. It doesn't take much, I think, from here for systemic issues in the banking system to help us go into another situation like 2008. Anyway, so what does this talk about with debt? So let's start here. Some highly leveraged companies could struggle to refinance their debt as a result of higher rates and market perceptions of higher credit risk, which could lead them to reduce investment and employment and in some cases default. So what this is saying, right, if I just zoom out again, sorry, I need two fingers there, and look over here. This is the chart of highly leveraged corporates refinancing in the next couple of years. So we've got 23 to 25, 26, 27, and 28 plus. And we've got people who need to refinance high yielding bonds or leveraged loans. Right now, with yields still being high, even though they have come down, you refinance a bond, high yielding bond right now, and your bond is going to be worth a lot less. So that's going to be an issue. If you have leveraged loans, let's say you're at a lower interest rate and you have to refinance onto a higher interest rate, that's obviously going to cause issues. And what it's saying is that these refinance events that business is going to have to go through are going to cost them a lot more money to save on that? Are they going to have to? Are they going to struggle and go down, or are they going to reduce investment? They're going to reduce employment, and again, this is another factor that layers onto a potential acceleration of the issues we are seeing. It says here, some systemic financial institutions have large exposures to highly indebted corporates. This includes some major UK banks. Okay, so this is not fear mongering, this is not shock mongering, it's not saying that they're all suddenly going to go down, it's just saying that there's a lot of big companies out there with a lot of highly leveraged debt on their books, and there's a lot of banks that have a lot of exposure to that. So again, I'm just trying here to join up all the dots of what could happen in, a scenario where if we do see the dominoes start to fall. And I believe this is quite different to the scenario that's being talked about quite a lot on social media, in forums, in mass media about inflation's done, interest rates coming down earlier than think we are, property market's going to resume. Two very, very different scenarios right there. So what are my conclusions? My conclusions are, we don't know which way things are going at the moment. I think it's impossible for anybody to say, because the economists don't know, right? Some economists are saying we'll be having rates drop by May in the UK next year. Others are saying it's going to be 2026 until we see rates drop. That's a massive skew, in terms of opinions from educated, competent, professional analysts and economists. So nobody can sit here and say which way it's going to go. I think we need to understand what the risks are and keep an eye on those leading indicators. One of the biggest ones for me that I picked up on there was the jobs report from KPMG, which showed a huge softening, way more than I was expecting, or I don't think a lot of people are expecting, and the fact that we still have systemic sticky inflation in the UK, quite different to US, with cost of housing going up, I would say compounding exponentially right now, and how that feeds in over the next few months. So that's what I've got for you today, team. I hope that was useful to go through. A little bit more sort of technical than normal, I'd suggest, not sort of economy based rather than necessarily property market based. But I wanted to sort of highlight it, and we'll just keep an eye on some of those leading indicators, I'll say, over the next 3 months. Keep track of where they're going. Let's see some of the questions we've got. Regreen, how are you doing? I know these are probably quite old, some of them. And by the way, if you've got any other questions, please get them in if you want to have a discussion about any of that. Regarding the labour market, all the talk of rising wages, at least the jobs I look at, they're still stuck at miserable rates, which have barely shifted in 10 years. I mean, look, rising wages are nominal rising wages. When we look at real wages, they've only just tipped past the real rate of inflation, because with inflation coming down, wages going up. So for the last 24 months, people have been eroding, and only now have they started having inflation beating. So there's a lot of ground to make up to get back to where we were 2 years ago. And if we've passed the peak of the wage growth and it's starting to come down, are we going to be able to make that up or not? Is a good question, and I don't know the answer to it. Regreen, pensioners getting inflation adjusted uplift. Yeah, totally. So again, when we're looking at different demographics are going to be benefiting or being affected differently with inflation. Again, state pension, triple lock, going up a lot again, right? People with lots of money in the bank don't have to worry about mortgages, are probably having, a very blessed life at the moment. Other people are not. There we go. So that's what I've got for you today, team. If we've got no more questions, I know it's a bit earlier than normal because I wanted to be done before the end of the working day. I will bid you adieu for today. If that was useful, give me a thumbs up. Don't forget, if you're not subscribed to the channel, please do subscribe. And by the way, thank you for everybody for putting your feedback in for the name of the community that I'm looking at launching at the beginning of 2024 for those people who are looking to get involved in property investing and looking for a bit of support, training, engagement, community to help them do that. I look forward to sharing more details with you of that in the future. In the meantime, enjoy your week, last full week before Christmas shutdown, and I'll see you later in the week.